What's up traders, welcome back. How are you doing today? As you can see on the title, we're going to go through this week's trading to see how you can take legal trades during December using the ICT 2022 model. I know that a lot of traders don't recommend trading during December. Even my mentor Michael himself. I'm not going to say anything, but I'm just going to let price action speak for itself. So let's go. So we are back on Nasdaq and S&P 500. So first, you always want to pull up your economic calendar. So since I only trade Nasdaq and gold, I have to look for the USD high impact or medium impact news. Because around those times, I'm going to anticipate manipulation and volatility injection. We only trade when the market is volatile because we don't want to get chopped. If you don't have news events, you're going to rely on time and price. We're going to use the New York Stock Exchange Open for volatility. All you have to do is Google the New York Stock Exchange time for your country. So it's 9:30 Eastern time in New York every day. So you're going to convert it to your local time. And that's when you're going to stock the market for your signatures. Before that, you must sit on the sides. In fact, buy a PlayStation so that you won't have to find yourself trading out of boredom. So we're going to mark the 9:30 New York open time. So before 9:30, you're going to mark your nearest swing points or liquidity. So you want to mark the nearest one below and the nearest one above price. So obviously you're going to arrive an hour before 9:30 so that you can be prepared or be ready. So this current candle is the 8:30. So you can see here that we have divergence, but it's before our trading time. So you wouldn't want to take the sell. You must respect your money. But if you did out of FOMO, your target was going to be here. So let's see what happened during the New York Open. So we had Nasdaq taking out liquidity, while S&P 500 is failing to do the same. Remember what I said in the previous video. Because they are positively correlated, they are supposed to move the same or do the same thing. So right now S&P 500 is waiting on Nasdaq to do damages so that they can move up. So if you look closely, you can see that S&P 500 is also trading into a 50-minute fair value gap, while Nasdaq is trading below swings. And anyways, a lot of people trade Nasdaq more than S&P 500. That's why you'll find that most of the time, Nasdaq is the one that takes out stops instead of S&P 500. So while this was happening, you can see that we had divergence. So let's go in here because that's where I took my trade that you see in the intro. So we're on the 5-minute time frame. Let's decode this time frame quickly because I took my trade on the 1 minute. So we have the same trading plan from the first model in the third video. So we have traded into liquidity already. So the order block that took out liquidity is this one. So we're going to highlight the high for our entry. Once we trade or close above it, you can set your buy limit at the candle's high and target the opposite swings. For model 2, you have to use this fair value gap because we had a market structure shift with displacement after a liquidity run. So you can see that it reacted on the body of the candle. It's because that's where most of the volume resides. You'll find that we have the same candles, but the size of the wicks are not the same size. Or sometimes you'll find that on my broker there's a gap between candles and on your broker there's no gaps. In ICT we call them vacuum blocks or volume imbalance. It's because brokers can use tools to play with the spreads or other things to manipulate you, but brokers are not the ones moving the market. But on your platform, they can manipulate the candles. That's all they can do. And now finally, let's jump to my favorite time frame for entry with better risk-reward ratios. Keep in mind, you have to consider risk-reward ratios if you're going to take the path of prop firms or getting funded. So we are on the 1 minute. I used the same trading plan, nothing special, no extra sauce. I just got a better entry. So when I saw that candle trading or closing above that order block, I didn't overthink. I jumped in. So when we were trading higher, I almost made a mistake by putting my stop loss to break even earlier without having 2 market structure breaks. Never put your stop loss to break even before having a double market structure break. It's because the price will most of the time come back to the order block or the fair value gap before exploding or leaving that area, because that's how we get the second model, and we're still targeting the same areas. So that's how far the trade went. So let's look at my live trade and how I managed it. So it's gonna be a commentary on this one. So we're on the live charts. You can see that the spread is super huge. So January, I'm changing the broker, but it doesn't matter because I'm gonna continue trading prop firm accounts. Plus, they have zero spreads because they are using commissions. So I saw that we already have divergence on Nasdaq on the left, taking out liquidity, and S&P 500 is trading into a fair value gap. So when I saw that, I jumped into the 5-minute time frame for entry. I didn't see anything interesting, so I jumped to the 1 minute and saw that the current candle is trading above the order block that took out liquidity. So I tried executing, and then I realized that I was on the wrong Nasdaq on the platform. So I changed quickly and re-entered. I took my time placing the stop loss, but obviously I won't do that on a prop firm account because they have strict rules. And then you can see that I almost placed my stop loss to break even before even 2 market structure breaks, which is a mistake. So you can see we currently had 1 market structure break in the form of a market structure shift. So I removed my stop loss from break even and I put it back to where it was. So I waited for that second market structure break. Plus, I saw the fair value gap, which is the second model. So which obviously means the price must come back, so which would have hit my stop loss. So if I had missed the first entry, I would have entered in that fair value gap that I highlighted. So when I got my second break, I went to break even. So I took some of my trades off. So on every swing, I was ready to pay myself. So when I got to TP, I removed my last remaining position manually. I just want you to realize that you only have to repeat the same progress every day without emotions. And the most important thing about trading is knowing when not to trade. That's going to happen by having a very small trading plan that you can follow every single time. If it's too long, you're going to skip some rules because you're not going to have a full checklist. So that's how inconsistency is born. So let's jump into a different day the same week to show you how this progress repeats every time. So this is the day prior to the trading day of the trade I just went to. Same thing, different day. First, like before, you always want to pull up your economic calendar. On this day, you can see that we had no high nor medium impact news. So now you're going to strictly rely on time and price, which is the same time that we got from Google for the New York Stock Exchange Open. So we're going to go ahead and mark that on our chart and show up an hour before to avoid being clumsy and all over the place, because you have to be ready and calm. In fact, tell your people that you're going to be busy for the next 3 hours. This is your job. You must respect it. So Nasdaq is very fast. So you're going to trade the 1 minute time frame. Your partner or family member must understand that you are busy and leave you to work because you don't disturb them at their workplace, right? So it's only fair. So you're going to mark your nearest swing points above and below, like always. And then you're going to wait for one of them to be taken out and start looking for divergence, for confirmation, and your entry patterns. So let's see what happened inside of here. So we want the 1 minute. We have our liquidity sweep with our 15-minute plus our 1 minute divergence. So you'll draw the 1 minute divergence on your own so that you can test yourself. So we're going to mark the order block that took out liquidity, which is this one right here, and mark our entry level. When you trade or close above it, it's game over. Don't overthink. If you're trading model 2, you have your fair value gap with market structure shift right here. If you weren't sure that this is a market structure shift, you can confirm it right here. Plus you also had a 1 minute divergence within the bigger 15-minute divergence. Then you swallow your fear and jump in and target the opposite swings. So that's it for this video, guys. I appreciate your positive feedback in the previous videos. We are on the same team as traders against the most intelligent algorithm. So don't be shy to leave a comment or to like the video if it was worth your time. But until I see you next time, that's Daniel.